Welcome to An Alternate View. I'm Hugh Anderson, and let's talk home prices. According to Dave Rosenberg, there was not one new home in the U.S. that sold for less than $150,000 in May, and just 2% sold between $150,000 and $200,000, and nearly 1 in 4 sold at over $500,000 or higher. So owner's equivalent rent is the amount of rent that would have to be paid in order to substitute a currently owned house as a rental property. This value is also referred to as rental equivalent. So why do I introduce this arcane terminology? Given its outsized weighting in the Consumer Price Index, be prepared for owner's equivalent rent to produce some surprising inflation numbers in the months ahead. Additionally, recent mortgage data has shown steady declines in applications. Perhaps we're finally beginning to see some resistance to rising home prices. You see, it's great when your home goes up in value, but unless you're going to move, you can't realize the increase. More importantly, the gain you enjoy on the sale is probably going to be consumed when you have to purchase a new place to live, and many times it's smaller. Next up, Uncle Sam and technology. The big tech companies are in Uncle Sam's crosshairs, with the House Judiciary Committee approving 5 key antitrust bills with more to follow. These bills will change 1. How your personal data is shared, 2. Limit merger and acquisition activity, and 3. Target the alleged monopoly power of certain platform giants. Although many of these stocks continue to lead the market higher, there could be less upside for investors should these regulatory burdens come to pass. So stay tuned. To be filed under Gotcha, demographer Neil Howe says the days of cheap on-demand service apps may be coming to an end. The price of the most popular ride-hailing services have increased 40% year over year, and a certain scooter company has increased their fare from $1 plus 15 cents per minute to $1 plus 45 cents per minute. That's a 26% increase. And the average cost of a popular private home vacation choice has increased 35% last quarter from a year earlier. So why are fares and fees rising? Many of these price increases are a direct result of the pandemic. COVID-19 did impact the sharing economy especially hard. Ride-sharing companies have had to raise fees due to both fewer customers and fewer drivers returning to work, and food delivery apps have had to raise prices to adjust to the increased usage and municipal caps on what they can charge restaurants. But many of these service apps had planned to raise prices in any case before the pandemic began. So why is that? These tech companies were founded on a strategy called Blitzscaling. Blitzscaling. This concept goes like this. You have a good idea, and then you raise plenty of money so you can offer low money-losing prices long enough to build an enormous customer base. Once you're number one in your field, you jack up the fees, make a lot of money, and start paying the early investors back. Now, many companies operating in the sharing economy claim they'll be profitable by the end of the year, and much of that will be due to their higher fares. You may be aware of a certain online retailing behemoth that has been following the same strategy, though on a much longer timescale. Investors always wondered how this company could justify its losses for so many years. Now they know. You wait until you are the totally dominant player, and then you wait for a good moment, the pandemic will do, to let your prices drift upward, and then your earnings will soar. But the sharing economy firms will need to be careful. Customers have learned to get through life without these amenities, and if the service increases their prices too much, consumers may just never go back to them and revert to cheaper hotels or taxis. That retailing behemoth mentioned earlier, of course, doesn't have that worry. Its customers are now hooked more than ever, especially on that one-day delivery button thing. But it faces a different sort of challenge, the growing threat of antitrust action. See my comments about Uncle Sam's crosshairs mentioned earlier. Low pricing that generates losses which the firm and investors fully expect to recoup later when competitors are eliminated is the FTC's textbook definition of predatory pricing. And for several decades, governments have been asleep at the switch and not enforced regulations already in place. But that era may be drawing to a close. And finally, money ain't garbage, but garbage certainly means money. Rich Bernstein, Chief Investment Officer at RB Advisors, notes on Twitter that the Dow Jones U.S. Waste and Disposal Services Index has generated an 11% annual return over the past 21 years, a period including the bursting of the tech bubble, the not-so-great financial crisis, and the pandemic. That's nearly double that of the tech-heavy NASDAQ 100, everybody's favorite investment darling. So that's it for this week. If you like what you heard, feel free to share with a friend or a loved one. So until next time, stay healthy, happy, and prosperous.